we go through this very simple question. The question I've shared here is a very simple one. I want to start by reading the question itself. Then I just want us to do some very brief reminders. The good thing is all of us have covered these concepts under AFR, and again, you've also covered it again, just as a reminder of the same concepts. So we are all good. All we are doing is just reminding ourselves. Nothing new at all. So I would read this question. Then I want us to pick some few elements that will help you to tackle any other question of the same kind, asking you the same concept. So let me go through together. Polo Limited acquired 90% of the ordinary shares of 10 shillings par value in Solo Limited. That was on 1st of November 2021, paying 30 shillings per share. The balance on Solo Limited's retained reserves at this date was 9,600 million shillings. All right, on 1st of May 2023, Polo Limited acquired 30% of Alo Limited's 10 shillings ordinary shares for 35 shillings per share. The statements of financial position of the three companies as at 31st of October 23 are provided below. So you look at the statements of financial positions there, members. I hope we are looking at it all together. You are able to see we've been given the statements for three companies. One is called Polo Limited, the other is Solo Limited, and the third one is called Alo Limited. So we can see the usual elements in the statement of financial position. We have non-current assets there, the PPE, obvious. This is published accounts, which we've done. Now, in this case, they're now doing the statement for you because what they're asking you now, we are in group accounts. So they've done the published accounts for each of these companies separate, and we are required to bring them together and consolidate statements here. So the usual elements there, we have PPE, investments, current assets, we have inventories, receivables, and bank balances. For equity and liabilities, we have ordinary share capital, and the par value is given as 10 shillings each. We have revenue reserves. So those are the two elements of equity given in this question here. We have non-current liabilities, which is only 10% debentures. Then we have current liabilities. We have payables, current tax, and bank overdraft. All right. We look at the additional informations, and this now tells you what you are required to adjust and any other clarifications that will help you to answer the question that the examiner is testing. So we look at the first additional information. It says the details relating to revenue reserves were as follows. So you realize under equity, we have revenue reserves, and the figures are given for the three companies. Now in note 1, they're giving you details relating to revenue reserves. So we have reserves as at 1st of November 22. So 1st of November 2022, look at the date when these statements are provided. The statements that we have were prepared as at 31st of October 2023. I hope you are noting the dates. They are very, very important. So, and in note 1, they're giving you that. And if you look at the statement of financial position, you see the revenue reserves have been given 87,600, 26,400, 16,800. It is those figures that they are breaking down to give you the details. You can see the totals are here, 87,600, 26,400, 16,800. So what the examiner is doing is to, split and give you an explanation of the revenue reserves at the start of the current financial year, whose statements are given above. So they are giving you the revenue reserves that started the period or that closed the previous period. Then they are giving you the retained earnings that were earned during the current year. You see, they say retained earnings for the year ended 31st of October 2023. So this is what was added to what opened the period to give you the closing retained earnings. Remember, when we were preparing published accounts, this is what we did under statement of changes in equity. We were drawing up our income statement, then we transfer profit for the year to the statement of changes in equity, and this is what they've given you a breakdown of. And we will always start or open the statement of changes in equity with the balances brought down. That is essentially what the examiner is doing here in summary. Let's look at note 2. It is the group's policy to value NCI at acquisition date at fair value. The fair value of non-controlling interest on 1st of November 2021 was 3,600 million shillings. All right, note 3. A check of 480 million from Solo Limited to Polo Limited. Can you hear some echo? Let me take care of it. All right, I was reading note number 3. A check of 480 million from Solo Limited to Polo Limited was not received until 3rd of November 2023. Intercompany balances are included in the accounts receivables and payables as appropriate. Note number 4. In October 2023, Polo Limited sold goods to Allo Limited. Polo Limited sold goods to Allo Limited for 780 million shillings. These were transferred at a markup of 30% on cost. 2/3 of these goods were still in the inventory of Allo Limited as at 31st of October 23. Number 5, just prior to its acquisition, Solo Limited was successful in applying for a 6-year license to dispose of waste products. The license was granted by the county government at no cost. However, Solo Limited estimated that the license was worth 2,160 million at the date of acquisition. The last additional information. On 1st of November 2021, Solo Limited owned an investment property that had a fair value of 1,440 million in excess of its net book value. The value of this property had not or has not changed since acquisition. Required computation of goodwill on each investment, then group statement of financial position as at 31st of October 2023. Members, I hope we've not just read words. I hope we've, read between the lines. We've read between the lines and we've at least understood what the examiner is trying to find out or maybe to ask us to do. So these are basically adjustments. Now, few areas or few points to note, members. I hope we are together. I still encourage everyone in this meeting, as we go through this together, remember, when you do not get, or maybe if you do not understand a concept, if you have a concern, if you have a question, feel free to ask. That's why we are here to make sure we clarify where we don't understand. I always say my intention is not to give you answers to these questions. I hope and I know all of us in this meeting, you have your files with questions and answers. You have them with you right now. You realize that you've not gone through a lot of them. You normally just collect them, but you don't go through them. Why do you think so? Because having those answers to those questions is not the most important thing. It is your understanding of the concepts. So I want to encourage us to think in that perspective. Let us understand, not just look for answers. Answers you can get. If you don't understand, those answers might not be very helpful to you. All right, now, a few reminders here, members. One thing that we remember about group accounts, now that we've covered it in details extensively, you realize that in group consolidation, this simply involves combining financial statements of a parent company and its subsidiaries as if they were a single entity, as if they were a single entity. And in that spirit of mentioning the parent and subsidiary, that already should remind us, and we need to have the purview at the back of our minds when we talk about group relationships. Group relationships. And when we talk about group relationships, we've just mentioned a parent. We've also mentioned subsidiary. Then I also believe and I also know that when you talk about the parent, we talk about subsidiary. There are things that will always also come into your mind. We talk about associate. We talk about associate. And we also should remember and remind ourselves of joint venture. Joint venture. Is there something I'm leaving out? I've talked about parent, subsidiary, associate, joint venture. We also know that companies just have investments. Now, as we remind ourselves of group relationships, what or who is a parent, who is a subsidiary, who is an associate, who is a joint venture, or which businesses? What is the relationships, like? When do we talk about all these terms? Do we have that clear understanding of this? Members, we need to remind ourselves, do we know who is a parent company? What qualifies a company to be called a parent company? I just want us to cover this thing very fast because we have the knowledge. We're just reminding ourselves. We already know, members. Let's just remind ourselves very fast. Parent company. What does it mean? What qualifies a company to be a parent? What qualifies a company to be a parent? Shareholding above 50%. Thank you, hello. Thank you, hello. Shareholding above 50%. All right. Somebody else, as I wait for somebody else, sees there is, okay, has controlling power. Thank you, Winnie. When you mention controlling power, I would want us to ask ourselves, what do we mean by control? What do we mean by control? Alex is telling us here, a parent controls 50% plus 1% of the other company. All right, thank you, Alex. So the members who contributed there, Alex and this first member, looking at the name, Elo, said that a parent has shareholding above 50%. 50 plus 1 is simply the same as 50, above 50%. So that's okay. Now, a subsidiary. Who is a subsidiary? Who is a subsidiary, members? Who is a subsidiary? So for the parent, I agree with the members. A parent company is that entity with control over one or more subsidiary. So it is not limited to only one. One company can have control over more than one other. You can get one parent controlling many other subsidiaries, like 3 or 4 subsidiaries. It's not necessarily one subsidiary. So let's also remember that as we talk about shareholding above 50%, also let us remind ourselves that this above 50% is control over one or more subsidiaries. So who is a subsidiary? Let's remind ourselves. When do we talk about subsidiary? Members, when do we talk about subsidiary? What qualifies a company to be called a subsidiary? Do you know the reason why we are looking at these concepts? Members, these examinations are not difficult. The only problem that normally we have or students have in exams is people are in a hurry with so many difficult things. You are forgetting the simple concepts. You end up failing not because you do not know, but because you got confused somewhere. You thought that it was difficult. Yet, what is being asked there is very simple. So let's not ignore these simple concepts. That's where the exam lies. All right, Win is telling us a subsidiary is an entity that is controlled by another entity for more than 50% of its equity capital. Thank you. Thank you. I think what Winnie has given us is quite comprehensive enough and self-explanatory. Alex is also giving us that subsidiary is an investee company where the parent company is the investor. Thank you. So members, I would want us to all, if you have a different view, you give it. And I agree with what the members they have said about subsidiary. So this is just an entity which is being controlled by another entity, which in this case is the parent. So an entity being controlled. So when I talk about subsidiary, I don't have to specifically talk about the percentage of ownership. Yeah, so I will just say an entity being controlled by another entity. And when this other entity that I'm talking about, this is basically the parent. Yes, because the reason why I don't have to mention the 50% is because so long as I've talked about control, so long as I've mentioned the word control, that basically has taken care of that 50 plus 1%. Well, once I've mentioned control, that should be enough. All right, members, who is an associate? Who is an associate? And the reason why I ask you these things is because it is you to find out. Like now the question that I've just read, and we all have it, we are looking at it right now. This question here, no one has told you who is the parent, who is the subsidiary, and who is the associate, or any other business relationship. It is you to gauge, it is you to find out, it is you to decide who is what type of relationship. That's why having this, reminding yourself about this will help you to know this company, what am I talking about? So that you get to connect with what the IASs provide. Because when you talk about group consolidation, this is under IFRS 10. Again, some of its concepts, especially when you talk about group, group consolidation combines 3 concepts. We have group statement of financial position, we have group income statement, we have group cash flows. So all those under IFRS 10, I guess is it IAS 27? Then of course, we have IAS 7 for the cash flows. But when we talk about group, I think we now moved to IAS 28, if I'm not wrong, but you can still confirm that. So associate, who is an associate? Who is an associate, members? We are reminding ourselves, let's not keep quiet because we already know. These are simple things, members. We are just reminding ourselves. We've talked about parent and subsidiary. We are now asking ourselves, who is an associate? Who is a joint venture? Which company? What qualifies that? Then, when do we talk about just a normal investment? Okay, I see members here. We have Winnie. An associate is an entity that the parent acquires less than 50% of its equity capital. Thank you, Alex. Associate is an investee company where the parent company has control of 21% to 49%. All right, all right, all right. Thank you. Elo is saying less than 50%, but not less than 20%. So I like the percentages you guys are giving there, meaning we have an idea and it's very good. So when I see Valentine, their company becomes an associate, when another company has significant influence over it. All right, thank you. So how is the significant? The degree of significance will be very important there, Valentine. Thank you for that perspective. But you have to remind yourself of the degree of significance. They have significant influence, but to what degree? That is very important. Because again, when talk about subsidiary, there is significant influence by another entity, who in this case is the parent. But we go ahead to specify that the significant influence is the control. Control means they have more than 50% shareholding or ownership, so that they have that influence. So this associate, I will agree, the associate, this is an entity whose influence, who is being influenced, or operations are being influenced, or control is being influenced to a certain percentage range. And I will agree, and the range sometimes when you can some people talk about 20%, between 20% to 50%, which essentially will still be okay. Some people go and try to be more specific, like what Alex gave us there, by saying ownership between 21% to 49. Some people even talk about 49.99%, but I will just leave it at 49%. All right. So the ownership or shareholding in a company between this range, above 20%, but below 50. Again, that is another perspective that you can also use. Above 20% and below 50%. Above 20% and below 50%. The range in between qualifies a company to be an associate. A joint venture, members, joint venture, joint venture, joint venture, joint venture. We are reminding ourselves what qualifies a company to be a joint venture. All right. Elo is saying 50%, 50-50. Alex, 50% to 50%. All right. All right. So when we talked about parent company, we were specific and said above 50%, above 50%. But now, when we come to joint venture, thank you, Elo and Alex and the other members there, we say now this is exactly 50% ownership. So whenever you see 50% ownership, that should tell you this is now a joint venture. And when do we now just talk about an investment? How do you know, or when do you know that this one is not a subsidiary, is not an associate, is not a joint venture, but to this other company, this is now just an investment? What guides you to just say this is now just an investment? Members, we are reminding ourselves, and these concepts are important. They are important. Good. I see Alex saying less than 20. Below 20, that is Violet. Thank you, guys. Thank you, guys. That's very good. That is very, very good. So that ownership or control, that is below 20%. Anything below 20%, that now just falls under the category of just a normal investment to that company. So members, I hope we all agree. Now, when we talk about control is a very, very important term when you talk about group accounts. Now, control simply means the power to govern financial and operating policies. Financial and operating policies. So for a company to control financial and operating policies, this company should hold more than 50% of ownership. That is when you have both financial and operating policies, you have the power to govern those two important aspects. That is when you talk about control. Power to govern. Power to govern. I've talked about financial and operating policies. So that's when you talk about control. All right. Now, this was just something to remind us so that we make sure we remember because it's important. Now, as we dive into this question that I want us to tackle, this question is very simple once you understand the concept. Now, with this, somebody now tell us what relationship do we have? Now, we are reminding ourselves of the concept, then we connect to the question and we move. So members, let's come up with this group structure. We have these three companies. Now tell us, with what we've just covered, somebody give us the group structure as I separate this page into two. Very good. Somebody just remind us as I separate this page into two and as I write here group structure. As I write here group structure. So refer to what we've just reminded ourselves and tell me, what is the group structure? What is the relationship? Who is the parent? Who is the subsidiary? Who is the associate? If there is any other relationship, if an investment or a joint venture, tell me. Tell me. That's why you are reminding ourselves. All right. Nathaniel is saying Polo is the parent. All right. Elo is saying Alo is the associate. Good. Good, 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 good. Thank you. Any other member? Polo is parent. Solo is subsidiary. Solo is subsidiary. All right. And Alo is associate. Thank you. Thank you, Winnie. Thank you, Sue. Thank you, Nathaniel. Val is saying also Polo is parent, Solo is subsidiary, and Alo is associate. Real Me is saying Solo is subsidiary. Thank you, guys. I hope we all agree that the members are all correct. Given that reminder, we are all correct. So I also agree that Polo is the parent. So we talk about the Polo Limited, this company here. I think it's Apollo with an H at the end. So let me put that. So I also agree that Polo is the parent. Now, as Polo being the parent, let me just do something like this here. So the reason why I just want to put it like this so that we can do the relationship very well. All right. So I also agree that Polo is the parent. And I also want to agree that this other company, Solo. So let's see. Polo acquired 90% of the ordinary shares of Solo. So if it is 90%, obviously it's already above 50%. So Polo becomes the parent because it already has significant control on the operations and financial aspects. So that already qualifies, is above, 50%. Then it is for Solo. So meaning Solo Limited now becomes the subsidiary. And if you look at the ownership is 90%. 90%, that's why it now becomes the subsidiary. I just write it in short like that. This is the parent. This is the parent. This is the parent like that. So this other company called Alo, I believe we also agree this now is an associate, as good members there have told us. This is now an associate and we call it Alo Limited. Now, after coming up with this group structure and getting to know, now what is the percentage of ownership? Polo Limited acquired 30% of Alo, 30% of Alo. So this is 30%, and I hope we also agree. This is between 21% and 49%. That is the same relationship that we came up with here. And that's why members have said that is an associate. Now, members, after having this group structure, the next step that I want us to ask ourselves is, what are the dates of the acquisitions? When did Solo Limited become the subsidiary? When did Alo become the associate? And when did the parent? Obviously, all this, when did Solo become, when did Alo become, it is in relation to the parent, because it is the parent who has that relationship with them. So if you look at the dates, you realize that 90% acquisition of Solo Limited, and you remember the par value, this happened on 1st of November 2021. 1st of November 2021, that date is very important. So I just want to type it, and we are going to see shortly when doing group accounts. Remember, the dates are very important, and you are going to see shortly why they are very important. Now, Alo became an associate on what date? And we get it from the information here. We were told on May 1st, 2023, Polo acquired 30% of Alo. So that was on May 1st, 2023. So date was 1, the month is May, and the year is 2023, like that. That is important. And we are going to see how it is important, And the reason why we are doing that is because I'm asking you just beside here. What period did the subsidiary trade with the parent? What period did the subsidiary trade with the parent? That's why this date will be important. Now, to answer that question, ask yourself, what is the reporting date? We are reporting, or we are preparing the statements as at 31st of October 2023. So kindly somebody tell us, between the dates when Solo became the subsidiary and when Alo became the associate, compare it with the date of preparation of the statements and tell me, what period did each of them trade together? You know, we are moving slowly. We are opening up this question and understanding what we need to look at. In an exam, that is how you need to think. Look at the group structure. Get the dates when the subsidiary was acquired, the associate, or any other, if it's a joint venture or something like that. Then now ask yourself, what period did they trade together? I see members are talking here. This is very good. Elo is saying 2 years. Thank you. Doro is also giving us 2 years. Grace is giving the same. Vayo is giving the same. Solo, 2 years. So Solo became a subsidiary for 2 years. For the other members, I believe you also understand why or how the 2 years is coming. Alex is doing the same. Win is also saying 2 years. Win is also adding something that Alo, who is the associate, was trading with the parent for only 6 months. Members, confirm Alo, confirm the associate. Members, let's confirm the associate. Winnie has given us that. Eileen is also saying 6 months. Alex, the 6 months. Okay, Vayo is also saying that. Valentine. Jacom is saying 6 months. Thank you. Admin 6, Doro 6. All right, members. I know all of us might not be able to type into this chat box, but I just want to believe. Please do not keep quiet if you have a question. Do not. Understand how members are getting this, because you'll be alone. Members, you'll be alone. Today we are together here. Others will be typing in very fast to respond. Tomorrow you'll be alone. So if you keep quiet and you are floating, when you'll be alone, you'll float even more, and not very good things will happen. But I want all of us, I'm praying that we all pass this paper and proceed and do other things. So do not keep quiet if you have a question. All right. Now, I agree that Solo Limited, who is the subsidiary, traded with the parent for 2 years. I also agree that Alo Limited, who is the associate, and we know why we say it is an associate, traded with the parent for only 6 months. And the difference is the date when it was acquired, and you compare the date of acquisition to the date of reporting or the date of the financial statements. That's how this is arrived at. And I believe all of us can be able to do that comfortably, because this is a must. In an exam on group accounts, you must be able to get those periods. We are going to shortly see how that is important. We're going to see how it is important and how we do it. All right. Now, members, in that spirit of reminding ourselves of those, I also want to believe that we know that when we talk about group accounts or consolidation, there are terms that normally come into our minds. We know there is something called goodwill. We know there is something called bargain purchase. We know there is something called NCI, the notorious NCI. Can mistreat you if you don't handle it very well. Goodwill, you do have no choice, my friends. You have no choice, guys. You just must understand goodwill. It is very important. Now, in an exam, the approach is very simple. This stage here is a must. This must be the first thing to do in an exam. What is the second thing that you must do in an exam? The second thing that you must do in an exam is to draw up the structure or the format of the statement you're supposed to prepare. But you realize the examiner in this case was very clever. Did not start by asking you a statement, but started by asking you what? Compute for me goodwill for each investment. That is what the examiner started with. You know why? Because this is also a mandatory stage that you need to pass. But if time is running out, you are a student who wants to harvest low-hanging fruits, do not even panic. Once you've done the group structure and you know the dates, you can simply rush very fast to the required and see what is required. If you are required to prepare group income statement or statement of profit or loss, draw the format. Then group statement of financial position, draw the format and start doing postings that do not require adjustment. Just post them, just maximize on the postings. So that even if time cuts you short, my friend, you will harvest a good score from there. So let's embrace that kind of approach. It will save you on that rainy day when you'll be alone, And it's not very far. It's very, very near. And it's coming closer each and each day. So my approach after having the group structure, the statement that we are supposed to prepare is a group statement of financial position. So what I want us to do is very simple. Without wasting time, I know we've not computed anything. I know there is goodwill we are supposed to compute, which is not a problem. In fact, it's a very easy thing. But to harvest maximum score, I would encourage you to go straight away and start drawing the format of that consolidated statement of financial position. And that is exactly what I want to do here as we do the adjustments. So members, as I do this, and because we've all agreed that Polo is the parent, I also believe we all agree that now the group is called Polo. If you don't agree, you tell us that that one is very wrong. We will listen to you. Very good. What are we preparing? Consolidated statement of financial position, like that. Very good. Now, members, with that, what I'm simply trying to do is to make sure I maximize on my entries. I know we've not computed. That is okay. But my interest is let's harvest and maximize on the postings. We know the format of the statement of financial position. It is the same format. There is no difference. And do you know what? I'm just copying the format from here. You don't even have to worry. And in fact, if you don't like things that are disturbing your head, no one will even penalize you if you come here and copy these things and then you paste. But as you do that, the only thing you need to remind yourself is of various points of differences. Do you know what I mean? What I mean is, when you talk about group statement of financial position, under non-current assets, you must be very careful with the investments part. Do you know why? Do you know why? The reason is very simple. This is the parent. The statement we are preparing is for the group. We are going to treat it as one entity. As one entity, now you know that whatever the parent paid to acquire this solo, who is now the subsidiary, to the parent or to Polo, that is an investment. Whatever Polo paid to acquire this associate, which is Allo Limited, whatever they paid, to them, that is an investment. And again, I want you to remember that the statement that we are looking at, the statement of financial position that we were given for all the three companies, was prepared as at 31st of October 2023. We are also preparing our statements at the same date. The only difference that we are now making is we are treating all the three companies as one. And look at the investment line. The parent has invested. We already know this is the parent. Look at the date of preparation. Look at the date we are consolidating. There is investments under parent. There is investments under the subsidiary. There is investments under associate. We have to be careful So as you copy these elements and pasting here in the format, be careful on the investments. Again, be careful and know and be aware that we will have some visitors in some sections. The visitors will come under equity. Under equity, when you talk about the NCI, this is a foreign element that now will come in because we're talking about a group. The parent has the majority. Look at the structure that we talked about, the relationships. The parent only has about 50%. In this our case, it is 90. There is another 10%. We cannot ignore the 10%. Those are also owners of this company. Even though they don't have influence, they do not have control, but they are still owners. We cannot ignore them. That's why we will have NCI as a new member of the equity section. Again, members, we must also remember that there is revenue reserves. And if you are keen, you will now understand why the examiner gave us note 1. This was already prepared with the figures of revenue reserves, but the examiner went ahead and gave us a breakdown on what makes up the totals of revenue reserves. Why do you think so? There is a very important step there. That's why the examiner did this. It is intentional because you are going to use it. You are going to need this information. And you know why? You have to know what was the retained profits that was transferred to the statement of financial position for that particular year. For each of these companies, you know the intention and the reason is because there is a new element you have to bring into that section of equity, and it is called the group retained earnings. Group retained earnings, very important. I've talked about 2 elements under equity, NCI and group retained earnings. I've also told you to be careful of investments because whatever the parent pays is an investment to it. So we are going to break down this and get to understand how do you manipulate that investment. But before we do that, we were on the format. Let's not forget what we were doing. I was just mentioning things. I've not said anything much. But what you need to do is to continue with the format. The reason is, let's maximize on the entries. I will start with the usual format, which all of us know. Nothing new. Nothing new, members. We talk about assets. And when we talk about assets, we are starting with non-current. So I encourage you to go and copy paste. Yes, I know I'm not doing that, but you can as well do it. No one will penalize you. So long as you know we have new elements in those sections, and you also know that there are those that you don't just transfer directly like that. Level of precision, very important. Our figures are in millions. So instead of disturbing myself typing, let me just refine to bring that millions there. Very good. I'm just coming and copying. We have PPE. Then I also just want to just take it the way it is. We have investment, but I'm hoping that you understood that there is some explanation and understanding we need to know about investment. Now, as I was talking about foreigners who are coming into our statement, they are not here in these prepared statements at the end of the financial year. But because we're talking about group, you see this part A, the required part A, you are told to compute goodwill. That goodwill we are computing, it will now fall under the section of PPE, the section of non-current assets. It will fall under the section of non-current assets. After PPE investments, then we remember goodwill will now come in here. If there is goodwill, if there is goodwill, it is not always mandatory that you must have goodwill. And we remind ourselves, what is goodwill? Please, that's a question to you. If you are not sure, please find out what is goodwill. You must have very clear understanding of what goodwill is about. Now, members, there is something that I also want you to be very careful about. When you look at the elements given under non-current assets, there were only 2. We've added goodwill here as a new entrant in this section. And when we've talked about the group structure that we have, members, you know that when we talk about goodwill, we are simply looking at the relationship between the parent and subsidiary. Now, what happens when we have this other third company, the Allo Limited, and we agree it is an associate? My question to you, when we talk about associate, does it affect goodwill? Will it also play a role in our goodwill computation? This should be very easy. Will that associate have a role in our goodwill computation? Members, will it have a role in our goodwill computation? I just want to see. We are talking about understanding. Grace is saying a big no. Winnie is saying a small no. Jaden is giving also a very big one. Liaka is giving a small one. Okay, very good. Dennis, Alex. All right. All right. So there are members who are really giving very big no's. Then Mercy is also having something to say, saying only if we had impairment. So Mercy, you're saying that goodwill computation for the associate will only have an impact if there is impairment. A good perspective. Let's think about that line that Mercy is trying to bring. DM is saying no. So members, I want us to continue with that as we think let's just hold on to that thought. Let's hold on to that thought as we continue with the format. But intentionally, obviously, whenever you start withdrawing the format, I want to encourage you to always leave some space. In case you have an element that you need to adjust or bring on board, you always have a space. It is normally a good practice. Please do not always complete everything. Always leave spaces on in between so that in case there is something, you'll always just slot it in without having to hustle so hard. All right. So after that, I would want us to go to the next section. That is now the current assets. Current assets. Current assets. This section normally has no much issues because we do not expect any new visitor here. There is normally no visitor coming in this case. We normally have the usual elements, or we call them the residents. And the residents here, we just refer to our statements that we were given here, and inventories, receivables, bank balance, inventories. But in some instances, it might have some visitors, but not always in all cases. But as we think about that, let me just type inventories like that. I've talked about receivables like that. And I know someone will like me to just write the full word trade receivables, but receivables alone is still okay. Then I've read something where there is bank balances like that. Then I also have good practice. Always leave spaces so that in case there is something, you will always slot it in. That closes the section of assets. I told you, members, as you do formats, as you do exam questions, you do not have to concentrate too much on aesthetics. What do I mean by aesthetics? You want to give total and current separate. You want to come and say total current assets. Then you still come again and say total assets. No one marks the subtotals here. No one marks. It makes your statement look very beautiful. But in an exam, your intention is the scores, not the aesthetics. So what I will say is total assets. But if you have time, please just do it. We have different examiners. You might get an examiner who will be very, very excited and happy if your statement looks beautiful. Yes, if you get examiners who like beautiful things, they will really be happy marking your paper, and they might be tempted. They might be carried away as we talk about equity and liabilities like that. This is the usual format. And obviously, I'm starting with equity. Again, in this section, you don't have to always type these titles like assets. You can even start with non-current assets. No one will penalize you for doing that. I'm just doing this because it's the usual format, but in an exam, no one marks or denies you mark. All right. The elements that we were given were only two, and I've told you the new entrants or the new visitors in this section, which will always come in because we're preparing group accounts. So This is ordinary share capital like that. Then after that, I've told you, besides, you see, we were given retained. It was not retained. We were given revenue reserves. You see, now, revenue reserves, I told you that's why the examiner gave us the breakdown in note 1 about the revenue reserves. So I will not go to the revenue reserves. I will not take revenue reserves to the consolidated statement. That's why it was broken down like this. What I will do is to just bring in the new entrants. And who are the new entrants? The group retained earnings and the NCI. The NCI, right? So group retained earnings, retained earnings, retained earnings, and then NCI. Those are the new entrants in that section. And then we go to the last part, the last bits, non-current assets, non-current liabilities. Non-current liabilities. I like assets. I don't know why. Liabilities. We are talking about liabilities here. And the non-current liabilities, I saw how many? I only saw one, I guess. 10% debentures. This one, I can even refer. I don't have to type. It's a lot of work. Then we come to current assets. Current liabilities, sorry, not assets. Liabilities like that. Let me put it in bold. Then I can also just refer to them. I don't have to type when already they are there, wasting a lot of time. Right. Now, I have those ones there. Under the current liabilities and non-current liabilities, you will hardly get new entrants, hardly get them. So in most cases, these are the areas you need to maximize on the entries because they will qualify for the low-hanging fruits. But obviously, I told you, have the norm of leaving some spaces in between. In case something comes up, you have where to put it. Total equity. And liabilities like that. All right, so once I have this, I will go ahead and that is where my totals will appear. Now, after I've done this, members, so let me just make sure that I have space for my totals here. And like I told you in an exam, you don't have to to use always 2 columns of totals. No one will penalize you if you use one, so long as you've already done your work well. So that's why normally I even use just 1 column. I don't have to have debit credit. Debit credit. This is at post-advanced level. You already know. All right, now members, I want us to adopt the basic policy of preparation of consolidated statement of financial position. We know the basic policy of preparation of this statement. When preparing consolidated statement of financial position, the steps are very clear. The first one is the format. I've told you that. The second thing is to know the new entrants. Who are the new entrants? Have named under non-current assets, one of them is goodwill. Under equity, have named 2 of them, group retained earnings and NCI. Besides that, you just have to think of the third element or the third step, which is now the policy. How do you do consolidation? We all know. Members, this is something we all know. But I want you to just make sure you remember. Remember that when preparing consolidated statement of financial position, you assume that, remember, we are talking about Polo Group. This is now the parent who has control. Who has control? We've reminded ourselves of what is control. Now, we assume that the parent owns 100% of the assets and liabilities. You acquire everything. Now, this acquisition, when you take the assets, you also inherit liabilities. The same way for the married fellows. If you marry your wife with both assets and liabilities, with both the good sides and the liabilities that comes with it, and the flows that come with it. You cannot accept your wife on one side. You accept her fully. If it is one-sided, then that group is not strong and it is not valid. So members, we combine the assets and liabilities of the parent and the subsidiary 100% line by line. 100% line by line. That is the basic rule. And when we talk about the investments, That is an area I'm going to talk about. But for now, let us pick on those common and usual elements. We combine or we consolidate 100%. Winnie is talking about what about its investment in associate. That's what I'm holding on to. And I've just said we are going to talk about it. Because when you talk about the parent paid some money to acquire the subsidiary, also paid some money to acquire the associate that we're talking about. That amount they spent is an investment. Associate ni mpango wa kando. Jacob, what are you saying? An associate is a side thing. All right, all right, all right. Yeah, so so long as it can help you remember them in an exam, please go ahead. Always remember that when you marry, you inherit your wife. You take your wife as your subsidiary with all her assets, in other words, with all her strengths and all her liabilities or flaws that she comes with. It is 100%. You have to inherit 100%. Don't say that I'm taking you today, but I don't like this, your son. If you didn't want the son, please, this is not your wife. Leave her alone. You have to take her fully, 100%. If she normally wakes up at night and shouts, and you've already accepted her, please accept her like that. Yes, liabilities are must. Liaka, you have to accept liabilities. Liabilities are must. Yes. So now, members, I want us to start. And when you talk about the investments, we need to know that when preparing consolidated statement of financial position, we need to eliminate the parent's investments in the subsidiary. And as we eliminate the investment in the subsidiary, this one we do against the share capital and pre-acquisition reserves. This is best explained when we are doing it, and we are going to see how it comes. That's why I'm holding on to that. We are going to calculate goodwill, and I've told you it is not always goodwill. You can always get the opposite, and we call it bargain purchase. Or a gain. Bargain purchase is like a gain where someone pays you less than what you are giving. That is a bargain purchase. Then we also compute the NCI. And we also make sure we remember, we will adjust intra-group transactions. And members, those are very critical areas that I would want us to remember. But because of my motive of harvesting low-hanging fruits, I want us to just go ahead and do the ones that do not require adjustments. Yes, let's do the ones that do not require adjustments so that we start straight away. Right, now, the first one is PPE. Now, we don't have to worry or look at the additional informations first. What we do, just take what the parent has, add what the subsidiary has. Remember, members, we have 3 companies here. You do not consolidate an associate. You do not consolidate an associate. You do not bring a mpango wa kando at home. You do not consolidate an associate. That mpango wa kando, you don't bring it as a member of the group. When doing your major investments, do it with your wife. Because you are a group. This other person is not a member of the group. So as we consolidate, let us know that we are adding assets and liabilities. So if you decide to inherit liabilities of your mpango wa kando, that is up to you. We have to only inherit liabilities from the member of the group who is the subsidiary. So do not consolidate an associate. So as we do and make these entries, we only concentrate on the 2 columns of Polo Limited and Solo Limited. Please do not consider this first. We are going to use this information. For now, as you consolidate, just pick the 2. Add them as we proceed. And we maximize on the entries. Yes. I know the problem with us men, we like consolidating liabilities. Yes. So do not accept liabilities. If you must have mpango wa kando, let it be a mutual benefit. Let it be a mutual benefit. Yes. Let it not be Let it be. Which relationship we used to learn biology is called symbiosis or what? I don't know. Let it be some relationship where both benefit. Do not inherit liabilities. Yes. Yes. So, yes, symbiotic. Thank you. Thank you, Jayden. Yes, let it be mutual benefit. Correct. Mutual. So that as you give her, she also gives you something. Yes. Lakini Mercy is telling us, pana jaribu bila pesa. Thank you. Members, let's continue. So let's take the parent PPE, we add to the subsidiary. So what we do, I've just put an equal sign. I go to our statements given. I pick the PPE of the parent, then I add the PPE of Solo Limited, who is the subsidiary. You do not consolidate the associate. So members, always remember, you do not consolidate an associate. So that's what I've done for the first element, that is PPE. I'm leaving investment alone first because we are going to get some explanation. So goodwill also we've not computed, so just leave it aside. In an exam, this will help you to maximize on your entries. Even if you don't get time to do these computations, members, you will come out with very good score if you adopt this kind of approach. So do for PPE, leave it alone. Come to current assets, do for inventories. I know there will be adjustments, but before then, please just pick and add. I pick the one for the parent, I add the subsidiary, and we go. Now I have inventories. Trade receivables, I do the same. I come, pick the one for the parent, then I add the trade receivables of the subsidiary like that. All right, very good, very good. So it's very interesting, very interesting. And by the way, for fellow gents who are here, uh, always remember, and I want you to try this. I want you to try this at your own time without anyone seeing. Do as you do your budget for your month, especially now that we are on 20th of October. I know for the civil servants who are in this meeting, your salaries normally come in the next 5 days or less. You'll be rich. And once you are rich, you are normally tempted to, send some cash to somebody, for that mutual benefit, which you know. So as you do that, I want you to compare, always make sure that you get value on any investment. That is an investment. When you pay for her rent, that's an investment. Do you get value out of it? What value are you getting in exchange? Do not just, as you are trying to be good. Yes, be good, be very good, be a very good person, but not at the expense of your own welfare. Your welfare is important because tomorrow when you don't have that money, my friend. All right, all right, all right. So if you look at, we call it cost benefit analysis. Cost benefit analysis. We're going to do management accounting. And in management accounting, there is the BEP analysis, and cost benefit analysis concept is always there, cost benefit. So try to make sure that whatever you spend on, there is some benefit out of it, cost benefit analysis. Do not just, do some of these things blindly. Because remember, because you don't consolidate an associate will not come to your rescue when you have excess liabilities. An associate will not come to your rescue when you have excess liabilities. Underline that statement. When you are, like now the parent company has taken control of Solo Limited fully. You see, you are inheriting both assets and liabilities 100%. Now, I want you to look at the liability section. Now, for the parent has also taken care of, is going to take the ordinary share capital, right? I know we have NCI, but all of that will now be in charge. The parent will be in charge of it, and the liabilities will clamp onto the parent's one, including the current liabilities. So if at the end of the day, after consolidation, the business is not going concern, meaning maybe the cash flow has been affected by any factors, the parent cannot withstand its own weight. The parent is highly levered. We know the knowledge of leverage. I believe FM, we are going to also cover some of those things. Leverage. We know operating leverage, financial leverage, all those. So whenever the liabilities, this business is not going concern anymore. You see this fellow here? You see this fellow? This fellow will not come and help here in anything. So as the parent with your subsidiary, you will be alone. You will be alone. Members, we are adding the assets and liabilities of the parent to the ones of the subsidiary 100%. We are assuming the parent has 100% control. So we also pick the bank balances, and this is pending any adjustment that will come. So I'll go to the statement provided. I pick the bank balance of the parent, and I add the bank balance of the subsidiary. You see the subsidiary is bringing zero. Subsidiary is bringing zero. It's all right. I don't want to think what I'm thinking, but assets, we are done. Because I don't go with subtotals, I will simply just do the totals like that. In an exam, just do everything. Just assume that you've already done everything. You don't care whether it is balancing or not balancing. That is not important here now. You've not done workings, you've not done adjustments, but giving that total there has no harm. Just go and do it. As you do the adjustments, you will see whether your statement will balance or not balance. All right. Equity and liabilities. We took assets 100%. We are doing the same. But under equity elements, under equity, I want us to be very careful under equity. And somebody can remind us, under equity, how do we consolidate equity elements under the group? How do we consolidate equity elements under the group? Very good, very good, very good. In fact, that's a very good point that we have to remember. How do we consolidate the equity section? Parent only. Thank you, Sylvia. Thank you, Sue. Thank you, Winnie, Nathaniel, Grace, Wilkister, CPA Isa, Real Me, Elo, parent only. That is very clear. Thank you, members. I hope all of us have taken note of that. We only take that of the parent only. We only take that of the parent only. So, in that spirit of taking what is just for the parent, I know we are going to look at if there will be any adjustments that will come. But because we are only transferring the figures as is before adjusting, we just pick the one for the parent and put it there. So I will just pick the parent ordinary share capital and bring it here, pending if there will be anything that will affect it like that. Now, retained earnings for the group and NCI, those ones are computational. We have to compute them. In fact, the ones that we have to compute, I can even highlight them in red so that we remember we have computations to do. Good. Non-current liabilities, this one 100%. Non-current liabilities. And in this section, you will hardly get an adjustment affecting such line. Non-current liabilities and current liabilities, mostly non-current liabilities, there is hardly an adjustment in that section. It is very hard to get an adjustment affecting that, meaning this is a straight score. In most cases, that will be a straight score because you will, in most cases, not likely to affect it in any way. You will always get a straight score on that. These others, you can adjust. Even bank balance can be adjusted. Trade receivables inventories may be adjusted, but section like this is a straight score. If you are supposed to get 2 marks for each and every correct entry, you already have it. Without you sweating or doing anything, you already have that score. So that's why it is important in an exam room, draw the format, do the entries, maximize on them so that you harvest such scores. Good. We come to current liabilities. Current liabilities may or may not have adjustments, but it is safer to always just pick it. If there is no adjustment, those are straight scores. I pick for the parent, I pick for subsidiary, then it comes like that. I go to current tax, I do the same. I pick for parent, I go pick for subsidiary, then I go like that. I come to bank OD. Bank OD is there. Bank OD, I pick for the parent, I pick for subsidiary, and it's all like that. Then I just say, I go and get the totals. I know it will not balance, but that does not scare me because that is not my intention now. I'm just harvesting low-hanging fruits. Members, I hope we are together and that step is well noted. Now, the next thing we're going to do is now to start doing the computational part of it. And the computational part of it, I want us to start with goodwill. And the reason why we are starting with goodwill is because goodwill is the first required here in part A. The examiner wants us to compute goodwill. So that step will be very, very important. Let's compute if there is goodwill. If there is no goodwill, we know what it means. That will be a bargain purchase. And that also now tells us what is goodwill, because it is a very, very important element that as a member in this waiting for this exam, you always have to remember and know what is goodwill and what are the methods of computing this goodwill and which one is more desired and what does the provision or IFRS guides you to go about this. But I want to take the easiest approach. I see some chart here. You get a different figure in tax, Winnie. I have not done any adjustment. Let me go and check on my tax. Current tax, what I've done is to add the one for the parent to the subsidiary with no any other adjustment. So Winnie, I believe if we pick the same figures and just add them, we should not have different result. So Winnie, please confirm, unless we have picked a wrong one or you have picked a wrong figure. Winnie, confirm. Winnie, confirm that. I believe we should have the same output because we are not adjusting. We are simply adding. Winnie, is that okay? Winnie, is that okay? Confirm. Confirm. All right, good. Now, members, we proceed and we now want to do the adjustment. And I was talking about goodwill and I started by saying I want to give you the simple approach. The simple approach. Now, what is the simple approach? When you are looking at goodwill, remember, goodwill, we have to look at what the parent paid to acquire the subsidiary. Then we also look at the fair value of NCI at acquisition. NCI, the non-controlling interest, the minority shareholders. Then we compare that with the fair value of net identifiable assets, where we say, now, as the parent, you've paid this. And as you pay to acquire this company 100%, remember, there are those minority shareholders. That's why we add NCI, fair value of NCI. And then after that, you compare that value to what you are getting in total of assets, the net assets of the company that you are acquiring, so that you ask yourself, did I pay more than the value I'm getting, or did I pay less than the value I'm getting? If you pay more than the value you are getting, then you've extended goodwill. You have some goodwill on it. You've paid more than what you are getting. All right? And this is not a very good comparison when it comes to your spouse. I don't want to go to that because it might open some veil when you're talking about, is it auditing or company law? There is some veil. Some veil, it will open some veil, which is not a very good, discussion. When you start comparing what you are paying and what you are getting in return, that discussion is not very good for our fellow colleagues. They don't like it. And also, it's not very fair to go that direction. So members, let's just know that goodwill, we're comparing what we are paying to acquire versus or vis-a-vis what we are getting in terms of value. Then we ask ourselves, did you give goodwill, or was there a bargain purchase? Did you gain on purchasing where you paid less, but you got more? If you are lucky, you pay less, but what you get is the value that you get is high. It's a very good thing. Now, I would want to put it in writing and say, cost of investment. I think this will be a very simple way to understand it. Investment, cost of investment. I wrote a quote. Cost of investment. Then I said, we add, I like using the word fair value of NCI at acquisition, like that. Then after adding the fair value of NCI at acquisition, we compare all of that to the fair value of net assets, or identifiable. You can use any of that word. Fair value of, you can say identifiable, or you can just say net assets. Net assets. Net assets acquired like that. Good. So that's when we talk about goodwill. If it is the opposite, if what the fair value is higher than what is paid, the cost plus the NCI at fair value, then now that's when we'll talk about the bargain purchase or gain on bargain purchase, where you go to the market and then you negotiate so that you get a higher value at a lower cost. All right, so that is it. We will also compute. I told you we are going to compute group retained earnings, NCI, but again, I left some issue on investment. I've not forgotten. We're going to declutter it in a short while, but let's start with goodwill. Now, computation of goodwill. We've already given our roadmap members. What is remaining? It's very simple. So let's go and compute this thing we call goodwill. Now, goodwill, we do goodwill for subsidiary, and I also want us to, beside it, I want us to do them together. Goodwill for subsidiary, then we also do if there was goodwill on acquisition of the associate. It is hardly there, but if it is there, that is very good. Yes, so we will check goodwill so that, and in most cases, when you compare associate, that is, if you relate it to the Mpango account that some good member said, is that always there will be goodwill in the real situation where what you pay or the cost you spend will always be higher than what you get in return. If the opposite is true, that is very good. Computation of goodwill. Very good. Computation of goodwill like that. Now, I've said we separate it into two. We start with subsidiary. Subsidiary, let me just write it here. Then we go and do the same. Do the same. For who? For this fellow, for this other fellow called the associate. For this other fellow called the associate, like that. So let me just put them in bold. Then we see how do we compute goodwill of the subsidiary. We've just given a roadmap here. We check on the cost of investment, commonly known as purchase consideration. Purchase consideration. Most people will relate to that term, purchase consideration, but it is simply the cost of investment. So you can decide to use that word. No one will penalize you. It means the same thing. Purchase consideration. Now, what did you pay to get it? And I want us to now start looking at the question, what was the purchase consideration looking like? What did it look like? And normally the examiner will guide you on that. Let's go to the start of the statement. Remember, if you are in an exam room and you've already done this structure in this case, you already know that even if you do not know, or maybe you don't have time to compute goodwill, you already have good score here. In case these liabilities will not have adjustments, you already have all the scores. If it is 2 marks each, check. These are already, how many entries? These are 4. You already have your 8 marks. If it is 8 out of 20, my friend, without doing anything much, you again check on this PPE. There is no adjustment. I mean, you already have a lot. Current assets, you cannot adjust all of them. There will be those that will stand alone the way they are. Yeah? So you will always get scores there. So that is an approach that I want to encourage you to adopt in an exam room. Now, we are doing adjustments. We've started with goodwill. That's what we are doing. We're starting by looking at purchase consideration, which is equivalent to the cost of the investment or the cost of purchase. Now, what did the parent pay to acquire the subsidiary? Now, what dowry did you pay when you were acquiring that your wife? How much? Did you take 2 goats? Did you take 1 cow? How much? Did you take 10? Now, let's see. In this our case, what did the parent pay? We start by looking at the statement. Polo Limited acquired 90% of the ordinary shares of 10 shillings per value in Solo Limited on 1st November 2021, paying 30 shillings per share. There is a very beautiful information there. They acquired by paying 30 shillings per share. And the par value is 10. You've been given par value. So that will form part of the purchase consideration. Then we continue by saying the balance on Solo Limited's retained reserves at this date was 9,600,000, was 9,600 million. So you see, in computation of our goodwill, we are going to see under the net assets of this subsidiary or of this company that was acquired, which is Solo Limited now here, we are going to now bring on board what was the value of the retained earnings at the date of acquisition. That value has been given to us here. That comes under section 2 on the net assets of the subsidiary. But we are still on the cost of investment, purchase consideration. We've just read one line talking about shares. Just talking about shares. We've not been told how much did they pay. It is about shares. Now we continue if there is any information that will be good to us. On 1st of May 23, Polo Limited acquired 30% of Alo. Now, this examiner has taken us now to the associate side, meaning the examiner is done with the subsidiary side with only those 2 lines of the statement. So let's pick up our purchase consideration from those 2 lines. In the additional information, I'm not sure if there is any information touching on purchase consideration, but if there is, somebody scan through and tell us if there is something affecting purchase consideration and additional information. For now, I've not seen, but if there is, go and tell us kindly. I know there is this information given for the 9,600 million. We're going to use it for the retained reserves. Yes, but let's move step by step. We start with the purchase consideration, and we've seen about shares. So for the subsidiary, it was acquired through purchase of ordinary share capital, and we've been given the price at which they purchased it. And again, we know the par value. And whenever you are given purchase price or the selling price or the market value of a share, the market price of a share, and you've also been given the par value, that's you start thinking, was the purchase at a premium or at par value? We are looking at consolidation, purchase consideration, whether there is a premium on purchase above the par value or it was bought at par value. The essence of it is all that will fall under purchase consideration. So really, no one will really narrow down and ask you, was there a premium on purchase of the share? That might not profoundly come out here. But at the back of your mind, you know what happens at that point. All right, now let's go ahead and do that. So I want to write here ordinary share capital. They purchased shares. So how did they purchase the shares? Let me push this aside kidogo, then I come here. How did they purchase the shares? Now the par value is given. So what is the number of shares of the subsidiary? The number of shares of the subsidiary, we go to the statement given, the statement of financial position, under the equity section. You see this, the share capital was 14,400 million. 14,400 million. Par value is 10 each. So if you want to get the number of shares of the subsidiary, you will take the share capital divided by the par value per share, to get the number of shares. To get the value, it was gotten by multiplying the number of shares by the par value per share, by the value per share. That's what gave this one here. So we want to get the number of shares. Then after getting the number of shares, we ask ourselves, now, if the parent acquired all these shares at a tune of, I don't want to use the word all. Remember, when consolidating under the equity section, we only picked the share capital of the parent. So it acquired 90%, not all. So when acquiring the 90%, they acquired this number of shares, 14,400 divided by 10, that is the number of shares. Then they acquired 90% of those shares. So let me put it in writing so that someone can see. I'm saying the parent acquired 90% of the shares. Which shares? How many shares? It is 90%, yes. How many shares? I can open a bracket and say the number of shares is 14,400. Divide by 10. I believe someone knows why I'm dividing by 10. To get the number of shares. 14,400 is the ordinary share capital, this one here. I'm dividing by 10 because it's the par value to give me the number, which I now have. So you realize that 90% of that shares, the parent acquired how much? The parent acquired 1296. 1296, 90% of those shares. So 1296 shares. But it acquired it at what rate? At what rate? It acquired it at a price of 30 shillings per share. It was given here by the examiner. I'm not picking it from anywhere else. It is here. They paid how much? 30 shillings per share. So what do we do? After getting the number of shares, we multiply that by 30. So what do I do? Multiply by 30 like that. What do I get? 38,880 like that. So that gives, the number of shares or the value. I'm not talking about now the number. This is the value that the parent paid in form of shares to purchase the shares. This is the value of the shares that the parent purchased. And it falls under purchase consideration. Members, I hope we are together. If you have a question, you ask. If you keep quiet, there is a time you'll be alone. So you'll regret why you did not ask. When you'll be alone, you'll regret why you did not ask. When you'll be alone, and it is very soon, very soon. All right. Liaka is asking, and Wilkista is asking that please repeat. Good members, I will repeat. This is what I've done. Let's check together again from what the examiner was saying. Liaka has already gotten it. All right. Wilkista, are you still? Are you also okay, or you still need the explanation? Liaka said, I don't know whether to call is a she or a he. You'll forgive me, but he or she is okay. All right, no worries. I'll repeat what I've done. Now, there is this statement which you were given and said, Polo Limited acquired 90% of the ordinary shares of 10 shillings per value in Solo Limited. Now, Solo Limited now is our subsidiary given owing to the percentage acquired. This is more than 50%. And it was on 1st of November. And they paid how much? 30 shillings per share. Full stop. So, in some instances, you realize that the parent, yes, the parent buys or purchases the shares, but again, the parent still goes ahead to give in some money, some cash, or there is some other purchase consideration. There is there are those questions where the examiner will tell you that the purchase consideration was paid, for example, through purchase of shares, there was some cash given, or any other thing, any other agreement. Some examiners can even be tricky and tell you, this purchase consideration, some of them was paid in form of maybe, for example, some other asset. But the good thing is they will give you the value. So you just pick the value. Don't care about what they purchased it with. Look at the value. Like in this our case, they did it in form of shares. What have we done? We've gone and calculated the value of the shares that they purchased. How did we do it? That's what I want to repeat. 1, the purchase price is 30 shillings. The par value is 10 shillings. The question we ask ourselves is, what was the number of shares in the subsidiary when it was being purchased, or in the subsidiary? That one we pick from the statement given of the financial position. Now, the ordinary share capital was 14,400. Par value is 10. Usually, with that information, you can get the number of shares. So the number of shares in the subsidiary is now 14,400 divided by 10. That is how much? 1440. So this is the number of shares in the subsidiary. Winnie, I hope we are together, and Wilkista. Now, that is the number of shares in the subsidiary. But how much did the parent acquire? The parent acquired only 90%. So if you ask yourself, how many shares did the parent acquire? How many shares did the parent acquire? The parent acquired 90% of the number of shares in the subsidiary. 90% of the number of shares in the subsidiary. So it is 90% of 1440. I hope you still remember how we got 1440. It was 14,400 ordinary share capital divided by 10, which is the par value. So 90% of that number of shares gives us the number of shares the parent acquired or purchased. Let me talk about purchased. They purchased how many shares? 1296. The question is, we are not interested in the number of shares. What are we interested in? The value. How much in value did they purchase the shares in terms of value? Purchase consideration, cost of investment. Cost of investment now is the number of shares they acquired or they purchased, which is what? 1296. We multiply by the price at which they purchased it. What price? It was given by the examiner. How much is it? 30 shillings. You can see it in the first line. 30 shillings. You see it, members. I hope you are seeing it. 30 shillings is there. 30 shillings is there. So what do? I came here and picked the number of shares that was purchased and multiply that by the price, which is 30. And that's how we got the 38,880. I hope someone has gotten it. I just hope. I just hope. I just hope somebody, Wilkister, Winnie, and any other person who did not understand it. I hope now we are good. Are we good? Are we good? Are we good? Thank you, Wilkister. Thank you, Wilkister. Very nice. Now we continue. That is done. Good. Now, after getting the ordinary share purchase, we've not been told if the parent paid any other cash. That was not said. We cannot assume. So we just now leave it at that and say that is the value they paid. Now, onto that, remember the formula or the approach that we gave. We say cost of investment. Now we've already computed the cost. What are we adding? Let's add the fair value of NCI at acquisition. The method we're using is full goodwill method. Full goodwill method, the most recommended in most cases. Full goodwill method. Even if the examiner does not tell you which method to use, always adopt full goodwill method. You compute the total goodwill. The total goodwill. That's why we are adding the fair value of NCI at acquisition. All right? Very good. Where do we get the fair value of NCI? Where do we get fair value of NCI? We go to the informations given here. At the start, did they tell us the fair value of NCI at acquisition? This was not mentioned in the first two lines because the second two lines is talking about the associate. Meaning, let's now go and check the additional information. Were we given the fair value of NCI at the date of acquisition? Note 1 is a breakdown of the revenue reserves. And the intention is for us to get to know what was the retained earnings transferred. This one is going to be helpful in computing the group retained earnings. Group retained earnings. It's going to be useful there. That's why the examiner gave it to us. But now we are scouting to look for NCI at acquisition. Let's all look at note 2. Something is there. Note 2 is saying it is the group's policy to value NCI at acquisition at fair value. Then the fair value of NCI on the 1st of November 2021, that was the date when the subsidiary was acquired. Remember that. At that date, the fair value was 3,600 million, and that's what we were looking for. So what do we do? What do we do? We come here and say fair value of NCI at acquisition. And what do we do to it? We bring it here, 3,600 million. 3,600 million. Remember, all our figures are in million, so writing 3,600 should be good enough. So I do that formatting and I say, I want to see what was the total purchase consideration. How much in total did both the parent and NCI, what did they pay in total to acquire? What did they pay in total to get full acquisition of this subsidiary? Both assets and liabilities of the subsidiary. So we come here and get the total using alt equals, and I have the total there. And because it's a total, let me do it some little justice there, 42,480. We are not done. We've just looked at the purchase consideration. This is the total of it. We are using full goodwill method. After that, we now compare it with the net assets of the subsidiary. This is now the third stage, the net assets, fair value of the net assets acquired, fair value of the net assets acquired. Now, this one now, I want to throw your mind back to a very simple concept that you started with in Form 1 or Form 2. You already knew, when you are doing business studies, you are told that assets is equal to equity plus liabilities. Were you told that? The answer is yes. Assets is equal to equity plus liabilities. In the format of the statement of financial position, you know very well that you are comparing net assets with total assets, which should be equal to total equity and total liabilities. I believe we all agree to that. This total here should be equal to this. That is the concept that you learned in Form 1. Assets is equal to equity plus liabilities. Now, do you know this also means that the total equity is equal to assets minus liabilities. That is also the true. Equity is assets minus liabilities. Meaning, when I talk about the net assets of the liabilities of the subsidiary, what I mean is assets minus liabilities. This is what I mean when I talk about net assets. Assets minus liabilities. In other words, what I mean is just go and pick the equity of the subsidiary and you have the net assets of the subsidiary. Members, I hope we are together. So that when I pick equity elements, somebody cannot do not ask me, but it was net assets. Why are you picking equity? I hope now we understand that net assets is equivalent to equity of the subsidiary. So we go there and say net assets of subsidiary. Very good. Subsidiary like that. Subsidiary like that. Very good. Now, borrowing onto that knowledge, what do I do here? I just pick the equity elements in our statement given, ordinary share capital, and I want you to look at the revenue reserves. Those were the equity elements. So I'm not typing the full term. It's a long word. Ordinary share capital, let me use OSC. Then I use revenue reserves. Members, I want us to combine this computation of goodwill with something that is going to make our work easy. You know what is it? I want us to compare. And the reason for doing this, remember, in our computation, in our statement, we have two elements here. You see, these fellows, these human beings are very difficult to deal with. These elements are very difficult to deal with. And in a bid to start looking for them, the good thing with these two new entrants is once you get one of them, the other one is automatically the balancing figure. Yes. Once everything is done and you get one of them, you don't have to struggle to get the other one. But in preparation to compute that one of them, we need to start preparing. Do you know what I mean? What I mean is, in our computation of goodwill, I want us to separate the net assets of the subsidiary into two sections. Because it is this subsidiary where we have NCI. Remember, we've only taken 90%. There are those 10%. We've also included the fair value of those 10%. You see them? Fair value of NCI at acquisition. We've also included it here. So we cannot assume this group of people. These people are very important. So in a bid to get to know the value of NCI that we will take here, we will need to know what was the value of net assets at the start or at the date of acquisition. We compare with the value at the date of the financial statement. That revolves around the reason why we have note number 1. So we have to remember that. So I want us to combine that. Victor is talking about deferred consideration. Deferred consideration. Using the word deferred there, meaning a postponed consideration. In case, Victor, there is a deferred consideration, it will be clearly postulated, it will be clearly stated. And when clearly stated, and there is a guarantee given the language that will be given that now we'll have a consideration of this amount or this and this exchange, that will form part of the purchase consideration. If it is in the agreement, you have to include it. Yes? So deferred simply means it has been postponed. So in case the agreement includes something that will be met after the acquisition and it is agreed, and again, the percentage of control, the percentage of ownership already guarantees control, then you can go ahead and consolidate and consider that consideration that has been agreed upon, even if not fulfilled at the moment. Please just go and consider it. Yes, Victor, I hope you are convinced. If you're not convinced, tell us. We disagree to agree. All right. What did I say? I was talking about the value of the subsidiary net assets at the start or at the date of acquisition and at the date of financial reporting. And that is going to help us to compute NCI. So it is not part of computation of goodwill, members. I want you to get it very clearly. When computing for goodwill, we are looking at the date of acquisition only. because goodwill arises when you buy or you acquire the subsidiary. But this other value of net assets at the date of reporting, this one is going to help us to compute NCI and retained earnings. It is not part of goodwill, but I'm bringing it in just to make our work easy. We don't have to repeat again the whole thing at the end. Somebody is asking, at what time are we finishing? I will also throw back the question to you members. At what time do you want me to finish? Even if it is now, I'll gladly grab my coffee and relax. Members, the floor is yours. At what time do you want us to finish? And I'm waiting. Yes. Yes. I'll be guided by your word. I'll be guided. Yes, someone is saying we finished the question. Esther is saying 7:30. Alex is saying 7. Alex, we only have 2 minutes to 7. All right. Sue is saying that we need a break. That is very good, Sue. Yes. Metrin is saying 7:30. Jacom is saying 8. Sylvia is saying you just continue. Sylvia is very loyal. Sylvia, you look to be a very loyal person. Mercy is saying let's finish. Okay. Yes, Liaka, it is always 7. Me, I can even stop now. Some of us work on holidays. Oh, Dama. Oh, Dama. 7:30. A break, then we finish. All right. All right, members. You have spoken. I have to listen. I'm very sorry for Dama, who is supposed to go to work today. All right. Now, I think the fair thing to do is let's have some short break. Let's have some short break. Then, remember, members, what we have done is quite a lot. What is remaining is very little. And by the direction that I've just taken in this question, where I'm bringing the value of the subsidiary at the end of the financial period, that already will give us a computation of NCI. And once we have NCI, group retained earnings, we don't have to compute. It will already balance that thing easily. So, but I agree. Let's have some break. Let's have some break. And then we resume after that. So let's have some 5 minutes, members. For those who are going to work, I'm sorry. And I hope that you'll catch up. In case you have a problem, for those who are going to work, please feel free. Feel free to ask. I will be there to assist you catch up with where you left it. So Dama and any other person who's going to work, please don't worry. Don't worry. You are not alone. You are not alone. We will always balance it out. So members, it is 6:58. Let's have 5 minutes. It is 6:59. Let's just say by 7:05. Let's pick it by 7:05. And we continue from there. And we see if we get tired along the way, we'll gladly relax. So let's have 5 minutes. Then we can pick it back at 7:05. 7:0. Please don't go back to sleep. And for those people who like doing that thing, all right, bye. 5 minutes.